Is the UK state pension a Ponzi scheme? Is national insurance a scam? Let's take a look at the definition of a Ponzi scheme. This is from Investopedia. A Ponzi scheme is a fraudulent investing scam promising high rates of return with little risk to investors. The Ponzi scheme generates returns for early investors by acquiring new investors. This is similar to a pyramid scheme in that both are based on using new investors' funds to pay the earlier backers. Both Ponzi schemes and pyramid schemes eventually bottom out when the flood of new investors dries up and there isn't enough money to go around. At that point, the schemes unravel. So let's look at what the national insurance actually pays for. This is from the .gov website. You pay national insurance contributions to qualify for certain benefits and the state pension. And we've got a table here that shows what you will qualify for if you pay the required years of national insurance. So you will be eligible for a basic state pension, additional state pension, new state pension, contribution-based job seekers allowance, contribution-based employment and support allowance, maternity allowance, and bereavement support payments. So this is what your national insurance payments are going towards funding. So you might expect the UK government to be saving up all this national insurance money, put it in a bank account somewhere in anticipation for your retirement. They have this huge pool of money which they can dish out to you when you get to retirement age after many years of hard work and contributing to national insurance. However, this is where the problem comes in. So this is from FT Advisors. The article is actually from last year and the data is from 2015 because, not surprisingly, the government don't actually like talking about this too often because it's a bit of an embarrassment. But UK pension liabilities surged by 1 trillion in 5 years. The total liability of the UK pension system increased by £1 trillion in 5 years to 7.6 trillion at the end of 2015. Figures from the Office for National Statistics show. However, only a third of the total is currently funded, which means the rest will have to be financed by tomorrow's workers. Doesn't that sound very much like the Ponzi scheme system? It's only sustainable while you had the flood of new investors to pay off the early investors. The early retirees can only be funded by a flood of new investors. So the rest will have to be financed by tomorrow's workers, warned Sir Stephen Webb, Director of Policy at Royal London and former Pensions Minister. The bulk of the 7.6 trillion liabilities are made up of government pensions, which with a total of 5.3 trillion are almost all unfunded. The state pension bill was at £4 trillion at the end of 2015, with the unfunded public sector scheme being responsible for another 900 billion or 0.9 trillion. The only liabilities that are currently funded are local government pension scheme with £0.3 trillion. Now, there's a few things the UK government can do to mitigate this problem, although I would expect almost certainly the UK state pension system to come crashing down at some point in the future. The first solution they can do to at least mitigate the problem for a while is to increase the state pension age. I mean, they've already done this before. They've increased the state pension retirement age from 65 to 68. I would only expect that to continue. Another solution which they're also doing is just reduce how much pensioners are given. You can either do this honestly by just saying, okay, we need to lower the amount we give you, or you basically just create inflation and don't increase the pension amount, the weekly amount, in line with inflation. So effectively, you just can buy less goods and services with your pension amount. The other way is to just increase the base of taxpayers to help fund everybody that's retired. Because one of the big problems is the ratio from people working to people that are retired. At the moment, it's around 1,000 workers for every 300 people that are retired. So it's roughly 10 to 3 ratio, and obviously as the demographics of the UK changes, we get an older population, that ratio ends up tipping, that you get more and more people that are retired, and while the pool of people that are actually paying taxes goes down. So this is one of the arguments that the UK government used for having high levels of immigration to help fund the pension liabilities or unfunded liabilities that they currently have. Whether this works or not, it remains to be seen. I mean, most people that come into the UK aren't really paying enough taxes that you're going to be able to mitigate this problem for that long. So the UK state pension system is inherently unstable. It has huge unfunded liabilities. If this was a private sector pension fund, it would almost certainly have been shut down by the regulators by now. Its liabilities are huge and the fund it has to pay for that is incredibly small. So it's essentially, by all rights, a Ponzi scheme. When will it collapse? Well, MoneyWise have this article here. So this is state pension fund could run out as soon as 2032. The balance of a fund that pays the state pension is expected to fall rapidly to zero around 2032, according to the Government Actuaries Department. Now, that obviously only anticipates no other external shocks. You know, if we see a huge crisis in the Eurozone, if we see something like an Italian debt crisis, if we see a huge recession, you know, with the country's really overdue a recession at this point. We haven't seen a recession since, it's been 10, 11 years now since the country was last in recession. So we're due a recession, quite likely a bigger recession. We're quite likely going to see sovereign debt crises spread through Europe. So any of those large external shocks could really bring forward how quickly we could see a pension crisis in the UK. But judging by all accounts, around the mid-2030s is when you're going to start seeing big problems in the UK state pension. So is the UK state pension system a Ponzi scheme? Well, if you just take the face definition of a Ponzi scheme being a fund that can only pay out by drawing in more and more investors to pay the early investors, the early retirees, then yes, the UK state pension system by that definition is a Ponzi scheme. Is it unethical? Is it immoral? Well, you have people, young workers now that are paying into a system, paying national insurance, paying taxes, who are going to expect to be receiving a pension, at least in their late 60s, maybe in their early 70s. They're going to be expecting that, but it's quite likely by that point the state pension will have gone. It will just become totally insolvent, had to be scrapped. So it's quite immoral on those grounds. You have young workers now paying into a system which they believe they're going to receive when they get to retirement age, but that's quite likely not going to happen. So my only advice would be to, if you're young, if you're fairly young, start paying into a private pension fund or start acquiring assets. There's a trillion and one ways you can do it. Just start thinking about your future now. Don't really rely on the government, because this system, this state pension system, is completely insolvent. There's no way it can continue working unless there's a huge overhaul. And again, this only relies on there being no huge external shocks, which we're quite likely to see over the next 10, 20 years. So there you go. UK pension system, is it a Ponzi scheme? In my opinion, yes, it probably is. So it's Jason from Liberty Bunker sign off, and I'll see you in the next video.